Hey, everybody, this is Chris Miles, anti-financial advisor here with Money Ripples. I want to show you something really important because I'm telling you, every time people keep telling me, hey, I got an infinite banking policy, or look at this, like I've got something too, mine works. I'm going to tell you that it's a dangerous place right now because how do you really know if you have the best infinite banking policy? And so I'm going to show you something here. This is actually an example from one of my clients that sent me an illustration from another infinite banker. Now, this is a guy that has no small reputation, big producer in the industry, has a really popular podcast, very well known in the infinite banking space, especially among chiropractors and people in the medical professions. But check this out. This is going to knock your socks off why you need to be careful about what you're doing here. So I'm using the same example of this person here. Now, this first one is actually the policy that this other guy was setting up. Again, this guy has no small reputation, very popular as an infinite banker. Notice that they're paying in $30,000 a year for 10 years and then $12,000 a year thereafter. So their minimum premium only goes down to about 40% of their max premium thereafter. Notice also that first year, they have about $17,000. This is what I refer to as a good infinite banking policy, right? It's just good. It's not great. It's definitely not the best. It's just good. It's better than doing traditional whole life, but it's not great. Again, $17,000. I mean, that means that really less than 60% of your money went into cash value that year. Notice the break-even point here on this one is after he's paid in for 10 years, he finally has just as much as what he paid into it. Now, notice mine. Now, this one I did a different amount because they wanted to see a bigger amount, right? Primarily because there's more cash in it. So this one actually has 40,000 a year going in. But remember, the principle is the same. So 40,000 a year going in. Remember, he had about 40% as a minimum after the 10th year. In this case, that would be like having $16,000 premium. Notice it's not. It's about $9,500. So much less. In fact, it's even less as of a minimum than even his 30,000 example you're putting in per year. Because just so you know, the more you put in these policies, the more you pay for it. Now, notice as well, year one, 32,000 is in there. So if you do the math, that means 80% goes in versus less than 60% in just year one alone. Our break-even point, rather than waiting 10 years, is actually going to be just about year 7. Like you're just a few $100 short of it. So year 7, you're doing that and well past it in year 8. So it's all done faster. Oh, by the way, they ran him as the ultra preferred health rating, the best health rating possible. We ran this about 2 or 3 levels lower at just an average non-tobacco health rating. So if we actually ran this apples to apples with his numbers, with this other guy's numbers, we would have came in even better. You would have been easily breaking even before, but by the 7th year, sometimes even by the 6th year. And by the way, this company is the second choice company that we use. This is not our first choice, but because these clients are in New York State, this is the best option that New York State really has, is Mass Mutual. Now, to see apples to apples, here's even a child policy. Child policies don't do as well as adult policies. But here's his example, 10,000 a year. And then after that, 6,000 a year. So they're paying 60% of that max thereafter. Notice only $3,700 goes in. That means 63% is going to costs. And you really don't break even. Even by the 10th year, you're not breaking even. You put in $100,000, you still have 89,000. It's not till the 13th year they have just 818,000, like what they paid into it. Ours, we do it by really the 8th year. They have $80,000 after paying it in, and look at that minimum. It's not $6,000. It's a quarter of that, $1,500. I'm telling you, time and time again, I see this. So many of you are getting ripped off because there is no magic in having you pay more in fees. That just means the money is gone out of your life. The key is if you can have minimal costs coming out of your policy, minimal costs coming out, this allows you to take that money and do other things with it to make better returns. This is where you can go and buy real estate properties and do things that actually create wealth. Because I'm going to tell you, no life insurance policy will ever get you financially free. But if you pay less than those insurance costs, more in cash, and then you can be able to borrow against it to invest in things like real estate or your own business or whatever you might be investing in. The great thing is this, is that you now can make returns inside your policy and in the place that you invested at the same time. You get the double dip. Your investment money pays you twice. That is the power of it, but you've got to get those costs down. And I'm telling you, we have 100% commitment that no one out there will beat our numbers. I can assure you of that. And if you ever want that questioned, if you want to see how your policies are doing currently, or you're getting other quotes, let us throw our hat in the ring and show you what we can do. Guys, you can go reach out to us, moneyripples.com, and go to the contact us page. Make it a wonderful day.